think that's started. Hello, everyone. Thank you so much for joining us at this Your Overseas Home webinar. My name is Greta, and I am a property consultant at Your Overseas Home and Italy Property Guides. So it's great to have so many of you with us today, whether you're watching live or on demand. Today, we will be chatting with Alex Ingrim, a private wealth manager at Chase Buchanan, about your financial considerations you should think about when moving to Italy. So before you start your presentation, Alex, please could you introduce yourself and tell us what Chase Buchanan does?
Yeah, absolutely. So as Greta said, I'm a private wealth manager at Chase Buchanan. We provide financial planning and financial advice for people who are looking to move to Europe. So Italy is one of our countries. I'm based in Florence in Italy. And for people that are looking to move to Italy, we help guide them on the different kinds of financial and tax considerations that they need to make before and after they move.
Brilliant. Okay, great. So once Alex has shared his presentation, we'll then open the floor up to questions. So if you have any as we go along, please type your questions just in the questions tab on the right-hand side of your screen. So we do hope to answer as many questions and queries as we can today. But if we don't get round to them all, please don't worry. Any unanswered questions will be forwarded to Alex and the team at Chase Buchanan.
Okay, thank you, Greta. So yeah, just a little bit more detail about me. Over 10 years in the wealth management industry in the UK and Europe. I've been living in Italy for the last 5 years. So I'm based in Florence and I have the firsthand experience of moving to Italy. I've also lived and worked in 6 countries. I've got a lot of experience moving. As you can probably hear from my accent, I am American. I'm also qualified in the UK and the US. So whether you're American, British, or another nationality, we typically have experience working with you and can serve an American or British client base. So just to dive right into what it means to be tax resident in Italy, there's a little bit of kind of a misconception about Italian tax residency and how you gain Italian tax residency. So the first thing to point out that's a little bit different from the UK is that the tax year in Italy is from the 1st of January to the 31st of December. There are local and regional taxes as well as national taxes in Italy. The local and regional taxes are quite small. They're usually not much of a consideration. But you're deemed tax resident in Italy if you've been in the anagrafe at your local comune for more than 183 days. And what the anagrafe is it's a register in each town at the town hall of who the residents are. So it's based on your presence in the register at town hall for more than half the year, and it is not based on your physical presence in the country. So what it means is that you can move to Italy, you can get set up in, say, the 1st of March, register yourself in the local anagrafe, then go back to the UK for the next 9 months of the year, and you can still be considered tax resident in Italy because it is not based on your physical presence. So that's the first thing that we point out to potential clients and people moving to Italy. Another piece of criteria, if you are not in the anagrafe potentially, is if your permanent abode is in Italy. So that's another key piece of criteria. Another is if your center of economic or family interest is in Italy. So a good example of this is if you are, for example, traveling for work, but a partner and children are based in Italy, children are going to school in Italy, then that can tie you to Italy to be tax resident there. So I think Valentino Rossi had a problem with this. He tried to live in Monaco and his children went to school in Milan and they caught him back into the net because of this and told him that he is not escaping the Italian tax net. So just a good example of how that works. So your fiscal obligations as an Italian tax resident. You have income tax on your worldwide earnings, a social security tax. For Americans, this can have a slightly different treatment. Capital gains tax, wealth taxes. So the IVAFE, that is on investments held abroad, and the IVIE is on real estate held abroad. You have to declare all your overseas assets. You have potentially inheritance tax, and then kind of very small property taxes to deal with. So on the income tax side, it's payable on your worldwide income. So if you are an Italian tax resident and you earn most of your income, say in France or the UK, it does not matter where it's earned or where your clients are necessarily, you are liable for tax on your worldwide income. Obviously, the situation can be a bit more nuanced than that. Social Security tax is applicable on earned income for those that are still working. And one thing that's key to point out is while income tax rates can be perceived as quite high in Italy, Social Security tax rates can also be quite high. So the Social Security contribution rates differ whether you're employed or self-employed, but if you're self-employed, it's 26.23% up to an income limit that I think hovers around 110,000 euros a year. So relatively high Social Security contribution rates. So these are the income tax rates. Italy famously has a reputation as being a relatively high tax jurisdiction, but we're going to jump into a little bit later how Italy's been mitigating that and been kind of reshaping their reputation to be a jurisdiction that's not only kind of a low income tax jurisdiction in some ways, but also provides a ton of financial planning and tax planning opportunities. So capital gains and wealth taxes, capital gains tax in Italy is a flat 26%. It's applicable to gains on kind of share portfolios and property, as well as dividends, and importantly, which is different than the UK and the US, interest income. So interest that you generate from savings accounts or bonds is the flat 26% too. That's not income taxable. The wealth tax on foreign property, so they call this a wealth tax. I like to think of it as a bad translation sometimes. The wealth tax on foreign property is equal to 0.76% of the original purchase price of the foreign property. For those of you that might be American and are used to paying pretty high property taxes, you can offset US property taxes against this value. And quite often that actually extinguishes the wealth tax on foreign property. Unfortunately, in the UK, if you are paying council tax on the property, council tax is low enough that it doesn't really extinguish the tax liability, but it's based on the original purchase price. The wealth tax on foreign investment accounts is 0.2% of the account value. That includes pensions. The key thing to point out here is that this just creates a level playing field. So if you're going to hold an investment account in Italy, that is, you get taxed at 0.2% per annum. People just don't see that because it automatically gets taken out of their account when it's in Italy. When it's foreign, it doesn't. So Italy is just trying to create a level playing field. They're not trying to be disadvantageous to people who hold money abroad. And then there is a wealth tax on bank accounts. It's 34 euros per year per account. So as you can see, some of the declarations are kind of onerous because you have to make sure that you declare everything. I'm going through this now because it is tax season in Italy. So it's not a very fun time where you have to gather all of kind of last year's data. So let's go through some of the really kind of more interesting points and the tax regimes in Italy that create a lot of planning opportunities. So you may have heard of some of these. There is a 7% flat tax regime in southern Italy. So this is available to new residents to Italy that currently are drawing a foreign pension. And that foreign pension can take many forms. If you have specific instances, feel free to ask, but it is very nuanced. It lasts up to 10 years. Once you are eligible for this tax regime, that 7% flat tax applies to most sources of income. So it replaces the capital gains tax of 26%. It replaces income tax on any pensions that you're drawing. And it replaces the 26% on dividends. So it's a 7% flat tax that covers a lot of different income categories. The eligibility for the scheme, importantly, depends on you being a new resident to Italy and moving to a comune, so a town in southern Italy with less than 20,000 residents. In southern Italy, in this context, think of it as south of Rome, south of Lazio. It does still include Abruzzo, which is kind of adjacent to Lazio, which is the state that Rome is. But think about it as south of Rome and the islands of Sardinia and Sicily. There is also no requirement to disclose foreign assets or pay wealth tax with this. So there can be a fair bit of savings there as well. So for retirees, this is a really competitive tax regime that provides a lot of financial planning opportunities. particularly if you're British and you're drawing a pension. If you're American, this does work a little bit differently. If anyone is American, you are still liable for your US income tax rates in a lot of instances. So it is not a scheme that allows you to lower your US taxes at all. The Impatriati regime applies to new residents to Italy that are still working. So what Italy is trying to do is actually attract people to come and live in the country with these schemes. Italy is actively trying to get more people to move, one, to the southern regions, because they've been a little bit depopulated, but two, they're trying to attract people that are of working age as well. So the Impatriati regime is actually one of the best things going in Europe, and it's not very well publicized. So this is for new residents to Italy that are still working. You get either a 70% or 90% deduction of your taxable income, depending on where you settle in Italy for the first 5 years. So if you settle in the south, so again, think south of Rome, you get a 90% deduction of your taxable income. So if you make 100 grand, your taxable income is 10. So think of it that way. You don't pay a lot of taxes on 10 grand worth of income. That lasts for the first 5 years. Then you have an ability to extend for another 5 with a 50% deduction if you have children or you purchase a property. If you have 3 children that are still minors, you get an even greater deduction. So again, you can see the common theme here is just trying to attract people, right? As many people as you have in your household, the better tax rates that you get. So you can't have been tax resident in Italy in either of the previous 2 tax years to be eligible for this. And again, importantly, this doesn't cover Social Security contributions. So there is also a 100,000 euro flat tax regime in Italy. This is kind of comparable to the resident non-dom regime that existed in the UK. And actually, interestingly, once the UK kind of started shutting that down, that's when this became very popular in Italy. So Milan has attracted a lot of people that previously had lived in London because of this regime. So it is just a flat tax of 100,000 euros that acts as a substitute for all your other tax liabilities. It lasts for 15 years. It doesn't cover any income that's generated in Italy. That's an important key. This is all about having income outside of Italy. You can extend it to other family members for an additional 25K a year. And I think, again, this seems like something that's only out there for people that are extremely wealthy. But when you run the numbers on the fact that you don't have to pay wealth tax, you don't have to pay income taxes, you don't have to pay capital gains tax, and that this covers everything, particularly it's substituting for the wealth tax, then it can be applicable in a lot more circumstances than are immediately obvious. So I think that's also kind of just a key. So inheritance tax, this is actually quite funny because Italy doesn't have this reputation, but it is considered by many international organizations as an inheritance tax haven. So your inheritance tax liability is based on your relationship to the deceased. Now, again, this is something that contextually makes a lot of sense in Italy because a lot of wealth is passed down generationally within Italian culture. So spouses and children have a 1 million euro exemption for each beneficiary. So if you are a spouse or a child, you can inherit 1 million euros worth of assets without any inheritance tax liability. Above and beyond that, it's just 4% tax on what you've inherited. So obviously, this is substantially different than the UK, where you have, just a band of about £325,000 and 40% above that, right? For siblings and other relatives, you have a 100 grand exemption and then a 6% tax above and beyond that. For all other relationships, it's just 8% tax on what you inherit. So it's really not onerous in any way. For property, there's a transfer tax. But again, this is minimal. It's kind of like 3% of the cadastral value. The cadastral value is essentially the value that was determined years ago for tax purposes, a lot like council tax in the UK. So, they're using values from like 1992, like when you pay council tax. It's just has not a very close relationship with what the value is in reality today. There are planning opportunities to lower inheritance tax payable, but as you can probably see, there's not a lot of concern around this when you're looking at financial planning in general. So Italian wills, kind of on the same subject, Italy operates a forced heirship system. So like many other continental European countries, they follow something called the Napoleonic Code. And what that means is only a portion of your Italian assets can be passed to whoever you like. Otherwise, there are set rules for how it has to be distributed through your bloodline. So, for example, if you have 2 children, there are set rules for how much of your estate has to pass to each child, and then you have a percentage that's free, right, that you can give to whoever you'd like. And your will conceptually has to follow this. Now, for those of us that aren't originally from Italy, and the EU has instituted a directive known as Brussels 4 that allows you to put into your Italian will a clause that states that you want your estate distributed under the laws of your country of birth or your country of origin. So, if you're British, you can essentially elect that the distribution, not the taxation, but the distribution takes place according to UK laws, right? Which then opens things up and you can kind of pass your estate to who you may like. But this is an important planning piece to think about. You do need an Italian will for Italian assets like property, and you do need to include a Brussels 4 election so that you can distribute the assets how you like, if that's important to you. Otherwise, if the will deviates from forced heirship rules, it can be contested if you don't include that clause. Again, in practice, how much that actually happens, I'm not quite sure. I've talked to many people that have deviated from that, and their children were totally fine with it because they'd had a conversation about it ahead of time. So some pitfalls to avoid when moving to Italy. These are really UK focused. UK tax-free savings products like ISAs and national savings and income products like premium bonds, they're taxable in Italy. They're not tax-free. If you make any changes within your ISA or take kind of distributions, those are going to be taxable in Italy. The sale of a UK property could, while you're an Italian tax resident, could potentially attract Italian capital gains tax. At the very least, it's going to make your life a little bit more complicated. The tax-free lump sum on UK pensions is taxable in Italy, so it is not tax-free. That is solely a UK concept. Italy doesn't recognize trusts. And actually, this is kind of a big piece for anyone who's looking to move to Italy. Italy sees through trusts. They are transparent for tax purposes. So it is kind of really important to look at, if you've got an estate plan in place prior to moving to Italy, whether it's compatible in Italy, because it very easily may not be. UK domiciled mutual funds and ETFs can be considered non-harmonized in Italy, and gains can be taxed at income tax rates. So that's kind of an interesting piece because it's not a very well understood or well-known law in the Italian tax code. What you really need to think about when moving to Italy, if you've got an ETF or mutual fund portfolio, is just about potentially moving it towards a European domiciled and focused portfolio so that it's held in Europe and uses European products rather than British products, which are not looked at as tax efficient in Italy. So those are some pitfalls from kind of a British perspective. And just to add something from an American perspective, Roth IRAs are not tax-free in Italy either. That is not a part of the double taxation agreement between the US and Italy. And then another piece that often gets brought up is both US Social Security and UK state pensions are taxable according to Italian income tax rates. So some people believe that there's a clause in the double taxation agreement that allows you to kind of get out of that. That's not how that works. It's actually focused on other types of government-derived pensions. UK state pension and US Social Security taxable in Italy. So if you are thinking of a move to Italy, this is just a short checklist that can help you out. It's important to speak to a regulated financial advisor like ourselves at Chase Buchanan before you make the move. UK IFAs can't offer advice in the EU unless they're registered to after Brexit. That was one of the major consequences of Brexit in our industry, is that you used to be able to offer advice and passport throughout the EU, and that's just no longer the case. It's important to review your savings and investment structures in UK pensions to understand your options ahead of time. Because if you plan ahead of time with a lot of these structures, you can actually avoid some of the tax consequences that we've been talking about. Sell your main residence in the UK before you become an Italian tax resident, just make your life easier. And if you need advice, you do need advice, absolutely, about estate planning when moving to Italy, or at least to review the planning that you have in place, because the systems are different. If you have Italian assets, get an Italian will. I think that's absolutely key. And yeah, those are the kind of the main points. And plan ahead of time. I mean, the more planning you can do ahead of time, the better. Absolutely. So those are my contact details, my mobile phone. I think we got some time for questions.
Yeah, great. Thank you so much, Alex. That's been really, really helpful. Yeah, we do have a few questions actually. So yeah, you all right if we get started now?
Okay. Let me bring some of these up.
Super. Yeah, I can read them out. So yeah. James has asked if one gets taxed twice on the same income, both in the UK and Italy.
No, there's a double taxation agreement in place between Italy and the UK. So what the double taxation agreements are in place to do is to actually point the governments towards who gets to tax what first. That's kind of essentially how they work. So Italy or the UK, depending on the income source, will have the first right to tax that income. And then, typically you would not have to pay tax twice. So as well, if you're a UK tax resident and you're moving to Italy, you're no longer going to be a UK tax resident, right? So you don't theoretically have a liability to the UK unless it's on an asset that is situated in the UK. So then if that's the case, you use the double taxation agreement to avail yourself of that kind of treaty and your treaty rights. That's kind of what they're called.
Sure. Okay. Thank you. Yeah. Also, James has said, is there a minimum income tax bracket below which one pays no tax at all?
No.
For example, about 12,000 in the UK.
No, and that's a kind of point of contention in Italy because it's not very nice, right?
Okay, great. Ronald has said, is there sales tax on the sale of a house in Italy? He has a house in Ansodonia, which he might want to sell. So what kind of tax does he pay on the money that he gets for it?
Capital gains tax. Either income tax or capital gains tax, you can actually choose. I just sold a house last year, so I'm going through that myself. It's capital gains tax.
Okay, great, thank you. Joanne has asked, are these inheritance tax rates for a spouse or child living in Italy or elsewhere in the world?
It's based on where the asset's located. So it's actually about where the asset's located rather than it being about where the person lives. So, if the assets like bank accounts, houses and things like that, right? That's kind of the key.
Okay, perfect. Does the sale of a UK property still attract CGT if it's your only UK property? James has asked.
It can attract CGT. Again, this is where you have to go to the double taxation treaty, and you also have to look at the way that Italy and the UK calculate capital gains tax on a home. So this is the real key, is that you can look at the double taxation treaty and who has first taxing right, and then who has secondary taxing rights, and then you have to look at the way that the gain is calculated, because there's different ways to calculate a gain within each system, and that's actually where you get caught out more. You'd have to actually like look at the specific circumstance and run the figures to make a good determination. And you definitely have to speak to an accountant, and we are not accountants.
Sure. Okay. John has said that he is a US citizen. He will be receiving Italian citizenship soon. He has no plans at this time to own a property or move to Italy, just visit. Is there any tax obligations with just having dual citizenship?
Nope. But the one thing that you do want to do, John, is you want to register yourself in a different anagrafe for Italian citizens that live abroad. So once you get your Italian citizenship, you want to register yourself as not living in Italy, which confirms your lack of Italian tax residency.
Great. Okay. Ben has said his elderly parents have a holiday house in Umbria. His wife and him are looking to buy it from them for 200,000 and use it as a second home / a holiday let. What taxes are liable?
Yeah, so you'd have kind of your stamp duty for a second home, which is higher than when it's a primary home. You would have your purchasing costs. You've got to pay your notaries fees. And then on a holiday let, actually there is a special tax regime in Italy. It's a flat tax regime that you can elect. It's around 20%, around there, 21%. And you can elect to use a flat tax for holiday let. So actually letting out property in Italy has different tax rates based on the type of contract that you use. So it's all based on the type of contract that you use. And that's the real key.
Okay. Rebecca has asked, is the taxable savings due to Brexit?
The taxable savings for what? Have to be a little bit more specific. Let me look at the question.
Okay, we might have time to come back to that. Okay, Joanne has said she'll not be ready to take her private pensions until she's a resident in Italy. Will she therefore not get 25% tax free?
Yeah, so once you're Italian tax resident, I mean, there's some planning that you could probably do around that, where you might look to crystallize your pension, take the 25% tax-free lump sum in the short, period before you move to Italy and gaining Italian tax residency in the new tax year. So yeah, there's some planning that you could do around that. That's not something that necessarily has to be set in stone, right? That's where you could talk to one of the members of the Chase Buchanan team, and we could kind of guide you on that.
Okay, great. Arlen has said that they're moving to the US with an elective visa for retirement. Is there anything unusual they need to be aware of?
For the elective residency visa and moving from the US?
Yes.
Yeah, I could give you, we could have a 45-minute session about that. So if you want to email me, I can give you a ton of tips. I help a lot of people that are moving from the US with an elective residency visa. There's a lot of intricate details that are involved in the move from the US to Italy. So I would suggest we have a separate conversation.
Sure. Okay, I think we have time for one more. So Matt said that you've mentioned at the outset that you are considered Italian residents if you are in Italy for more than 183 days. Does that mean that if you're buying as a holiday home, you would by default be considered an Italian resident?
No, so this is actually really important. It's a good question. So when you buy a holiday home in Italy, and what often happens is the agent, so if you're buying a holiday home, the stamp duty is different if you're buying a holiday home than your primary home. And what the agent used to do pre-Brexit, especially with Brits, was encourage you to go to the local commune and enlist yourself at town hall as being resident in the commune, and then you save yourself a lot of money on upfront taxes. What it did is it made you liable to your worldwide income being liable to Italian taxes. So it's very important if you're buying a holiday home to distinguish the fact that it is a holiday home. And then if you are moving to, obviously, like for those of us that aren't Italian citizens or EU citizens, and you can't spend the 183 days anyway, you're not going to be able to register in the Anagrafe, et cetera, et cetera. It is really based on the registration in the Anagrafe. That is by far the most important determining criteria.
Great. Okay, well, thank you so much. That's about all we have time for in today's session. So yeah, thanks again, Alex, for all your insightful tips and advice. We strongly recommend you to get in touch with Chase Buchanan directly to discuss your requirements in detail. So we'll be in touch with their details shortly. Thank you to our speaker for sharing your knowledge with us today, and thank you to all the listeners for joining us. So yeah, thanks again and happy property hunting.
Thanks, everyone. Have a good day.